Thank you, Mr. Chair, and thanks very much to the committee today for your invitation to speak on Bill C-69. I'd like to restrict my opening remarks to four key areas: the capital gains inclusion rate, the global minimum tax, changes to the employment insurance system, and the national school food program. As a longtime advocate for higher capital gains inclusion rates, I'm pleased to see that we are making progress on this issue. From 1988 through 2000, we had similar or even higher inclusion rates on capital gains. And these higher rates did not have the $250,000 exclusion that we're seeing in this year's budget. And corporate income tax rates were double what they were today. Despite concerns that investment would fall due to higher capital gains taxation over this period, investment actually doubled over this period as a proportion of GDP, rising from 2.6% of GDP for machinery and equipment to 4% by the end of the decade, and from 1% of GDP to over 2% for intellectual property. In fact, investment in machinery and equipment in 2000 is higher than it is even today, where it stands at only 3% of GDP. Companies do not invest to chase low tax rates. They invest because they think they can make money. Corporate investments follow the business cycle. A strong economy leads to strong corporate investment. Companies move to capitalize on growth and let the accountants figure out how to reduce taxes after the fact. A higher inclusion rate equalizes treatment between companies in different sectors. Companies that buy and sell assets do not get a tax preference versus other companies that sell goods and services, although that's what the different tax treatment for capital gains allows. In the long run, we should move to full inclusion. As the Carter Commission famously said, a buck is a buck, whether you're trading stocks or sweeping floors. That full inclusion should be with an inflationary increase to the capital purchase price. Longer-term holdings, such as family cottages or farms, could get a very small, if any, inclusion, whereas short-term capital gains from stock trading, for example, would be at full inclusion. It's also worth considering how the proceeds from the smaller tax break on capital gains are being used. An important driver of capital gains recently has been real estate investing due to out-of-control housing market prices. Effectively, substantial capital gains for investors are being made at the expense of those seeking housing. And the proceeds of a higher inclusion rate are funding the expansion of more affordable housing. Those making the real estate gains are partially paying for important moves to limit the terrible impacts on housing affordability. I am encouraged to see the global minimum tax legislation proceeding is an important tool to combat profit shifting from Canada to low or no tax international jurisdictions. The epidemic of multinationals using various means to avoid their fair share of Canadian corporate income taxes while relying on Canadian infrastructure, workers, and legal system must be addressed. The minimum tax is expected to raise almost $3 billion starting in 26-27, and it is crucial to ensure that companies making money here are paying taxes here as well. The changes to employment insurance in this budget are disappointing. Many EI experts were consulted at length over the past year about improvements following the pandemic and our experience with emergency benefits. Unfortunately, little has fundamentally changed, although the budget does continue a limited EI extension for seasonal workers that would have expired in the fall. I encourage members to consider something that we're working on, a new EI stream called the EI Emergency Response Measures, which the ESDC minister could trigger for a particular geographic area. This could be triggered in the case of evacuations for wildfires or floods, or even broader events like, heaven forbid, another pandemic where workplaces are shut down. Triggering these measures would produce an immediate relaxation of EI access rules. It would eliminate the one-week waiting period, reduce the hours needed to access EI benefits, and provide a floor on benefits. We still have no institutional response to ever-growing threats related to climate or health. As shown during the pandemic, cash supports are critical to keeping workers and families afloat during emergencies. Finally, I'd like to commend this budget on an important step forward to a national school food program. This is something we've long advocated for, and with Budget 2024, we are now seeing money flowing to design the basics. Ideally, this program would be universal, where all children receive a healthy and free lunch at school every day, eliminating the stigmatization that such programs can bring if only some students benefit. As envisioned by Budget 2024, this program is not universal. A national universal school food program would likely cost roughly $2.5 billion a year, although the measures in Budget 2024 only commit roughly $200 million a year. Nevertheless, it is an important start to establish the provincial and territorial agreements to implement a broader program. Thank you very much, and I look forward to your questions.